Hello, everyone, and welcome to another episode of the MRMIA broadcast. I'm your host, Mark LaPrince, and you're listening to the Model Risk Management International Association broadcast. And today we have here Charles Maynor, who is Retail Credit Risk Head of Model Development at Truist. And he's here to share some of his thoughts on how the COVID-19 pandemic has actually impacted him and his modeling team here at Truist. So, Charles, why don't you go ahead and give yourself a short introduction?
Hi, folks. Thanks for joining. I have been with Truist since 2014. Originally, it was Heritage BB&T. Later, we became Truist a year ago this week. And my background is really quantitative modeling, quantitative model development. And I was brought to BB&T or joined BB&T to lead credit risk model development. And as part of the new organization at Truist, I am head of retail credit risk model development, both vended models, custom vended models, but our focus is on internally developed models. We also manage ongoing monitoring, cover documentation, and also assurance provider relations as well, such as corporate audit, model risk management, of course, and regulatory relations specific to the models.
Excellent, excellent. So, sounds like when the pandemic hit, it didn't affect your job one bit. That's what you're telling me. Is
Thus far, no. It may have influenced it with some ask, but because one area we do not cover is covered by a specific area. Currently, it's finance. That is
Mhm.
CCAR and CECL. And the CCAR and CECL areas had a lot of interest from regulators in how overlays due to accommodations were being handled.
Mhm. Okay, so then um, walk me through the different types of modeling that you do in kind of your group and some of the ways that the pandemic has shifted consumer behavior, possibly affecting, kind of the underwriting process or account management that you guys do.
Sure. Well, the areas of model coverage that we have are underwriting
Mhm.
decisioning, account management, such as with open lines, bank card, obviously, HELOCs. Um, we do pipeline credit loss models, and that is for business forecasting as well as just general relaying back to analysts and kind of the projection of kind of where losses are going. And it also helps them with their annual forecast. The other area would be collections prioritization, more from an operational standpoint. And then lastly, mostly done by our Heritage SunTrust folks, but we will probably pursue this under Truist, and that would be for our recovery, post-charge-off recovery efforts. So I think the second part of the question, Mark, was how have we seen thus far the influence from COVID?
Mhm.
The influence with underwriting models is, well, with all of our models, but predominantly underwriting models has been really challenging to assess because the core metric that we really evaluate most of our underwriting models on is rank ordering. Calibration accuracy is important. It's not something that has drifted a lot in our models. And the rank ordering, for the most part, has held up. As many of the folks probably on the call or listening in may have seen, is that most of the influences over underwriting is underwriting policies and how that may change. One of the mitigants Truist has done thus far, and I'm sure we are far from unique, is just make changes, more qualitative-based changes to our underwriting, raising FICO floors. Even though we do have internal models, FICO is still sort of the language by which all of retail credit really deals with.
Mhm.
So that's one. Just making some general underwriting income changes, for instance, through policy. So there have probably been some what we might call model cutoff scores,
Mhm.
The way Truist does it, we'll take the scores, allocate them to a range, and they basically become a pseudo rating. And then the ratings serve as the floor by which we would approve or reject applications for decisioning or acceptance, if you will.
Okay. Okay.
EL models, and I don't. There may be a variety of opinions out there with CCAR, CECL, but at least our expected loss models, they're developed on areas or time periods that were clearly pre-COVID.
Mhm.
And because of the accommodations that are still ongoing, as in not only existing accommodations, but accommodations that are new, we haven't actually seen it manifest other than believing that our loss forecast they're too high now because of
Right.
accommodations, but they will likely be too low when those accommodations start to roll off. Um, the big challenge really we've has more of a technical standpoint of how to score or incorporate the accommodations. And I think many of the CCAR teams
Mhm.
across the industry are doing this, but really you're almost having to artificially give them a pass where they just continue their past state and they continue to slide from time period to time period across until it wears off, and then they would, as in the accommodations would expire, and
Mhm.
then they would start to, if you will, asymptote back to the norm. That's really what we're looking at. It's a
Okay.
guess like anybody else's, because we just haven't seen it yet.
Right.
Thematically, I think most everyone agree. I mean, models do a great job telling you what they've seen. And as long as we
Mhm.
continue to see what they've seen, models work. They work well. But when we hit areas where it was the financial crisis that went on back in 2008, 2009, now with the pandemic, not all, but a lot of bets are off on models. But at the same
Right.
time, it's still the best we have. We do not have an alternative.
Mhm.
It's The alternative would be qualitative judgment, and I think I'm yet to meet anybody or chat with anybody that believes on average qualitative
Mhm.
is going to beat a model. So,
Yeah.
Mark.
Yeah. And this is kind of some of the common themes that we've seen in general across the board is continued use of the models, just even if it is a flag in the ground. We know it's not in the right place, but at least it serves as a reference point, right? And then from there, we can either adjust the data, as you were talking about, from adding kind of the government assistance
Mhm.
assumptions in, or you can adjust the output afterward. So,
Right, exactly.
um, what other measures have you, the modelers on your team, or other folks on your team, taken to kind of also look at the kind of change in data um, and the other impacts that COVID-19 has on people's behavior? Um, and what I mean by this is, we've seen interest rates drop to its lowest rates.
Correct.
Some of the unemployment rate factors have just expanded up very quickly. Oil went negative. We're seeing a lot of data points that we just never considered for, accounted for. Um, on top of that, transactions changing, behaviors changing, uh, government assistance programs, so on and so forth.
Right.
This is, uh, restrictions on travel, right? I've heard people talk that this is almost like similar to almost a war effort that the government has put effort into stopping this virus. So, given all these kinds of changes, what's remaining steady with the models? What's changing, and what is your team's doing to address those?
Well, the best example that we've seen, ironically, was our Wall Street Journal. I had a great
Mhm.
article, and we've seen it. And at first, it's unintuitive until you think about it, it becomes more intuitive. And a lot of the help through government programs have helped people, but rather than go out and spend the money, which is
Mm-hmm.
probably from an economist will let us see them do, they paid their debt down. And so, ironically, we've actually seen FICO scores tick up about 5 to 10 points. Same way with our internal scores.
Mm-hmm.
Now, in theory, the way that would manifest is your calibration accuracy would start to drift. And so a FICO score or an internal score of 710 would start to look more like a 700 or a
Okay.
695, right, so to speak. And it's because of the what we might call artificial or non-natural pay down of debt, because debt utilization are huge inputs into credit scores. And so, because the whole basis for credit scores are payment performance, it really doesn't have a whole lot to do with an individual's liquidity position. Um, and so, again, that's what we've seen. We haven't seen a lot of material change in the credit quality coming. Our risk acceptance criteria has probably been raised a little bit, but more for safety. Uh, we have seen small businesses, though, get crushed. And so when my area is over retail, but micro small businesses and sole proprietorships would fall currently under the Truist retail credit
Okay.
risk area. In those areas, well, certain of them have been. If you're in entertainment, if you're in food, anything having to do travel, et cetera, has really been killed. But other areas, seems like a lot of people are remodeling right now. Contractors that are in construction, house construction, they're doing quite well. They're very busy. So, Mark, I hate to say it depends. It's probably a good way to say that. So it varies. So,
Yeah. And that's very interesting because I was reading an article the other day saying that what we might need is better data. A guy was saying that rather than looking at the designation for perhaps a restaurant, we need more information, such as whether they're a high-end restaurant downtown versus a takeout area, or
sure,
we need to
fair
look
enough.
at, whether someone just more granularity in certain types of data to help delineate kinds of decisions and match where the risk is actually following.
So, Mark, probably getting off the topic slightly
Mm-hmm.
of models, but that behavioral question or concept is very key. I mean, I say as Americans, but we're a very innovative country. That's part of being entrepreneurial. And so, grocery stores at the very beginning of the pandemic enjoyed a substantially increased demand. In fact, I even saw it qualitatively, some prices going up, and they claimed it was supply, maybe so, but I don't know that their prices have ever back down when some of the suppliers went back to work.
Uh-huh.
But in the meantime, what has happened, at least in a lot of the restaurants in the area where I live, which is in North Carolina, have gotten innovative and have really focused on takeout or cook at home. And the quality of those meals have been outstanding, almost restaurant quality. And that was something else that I have come across, and maybe in the journal, New York Times again, that suggested restaurants are beginning to catch on how to address the pandemic, stay in business, and actually continue to have a thriving business. And I think, in fact, I think it was in Kroger's earnings not long ago. They said I think their profits had basically not changed as much as they had in the previous quarter over quarter, simply because the demand was starting to either plateau or shift slightly back to restaurants.
Right. Right.
So,
Yeah. So that's very interesting. What does the future look like? Do we see in the crystal ball
the
of
future's
what we have
bright.
right
Yeah,
now?
we need to go along with plastics. Yeah, buy plastic. Yeah. Anyway,
Right,
go
right.
ahead.
So in this very cloudy crystal ball, right? What can you tell us about the future of kind of the modeling in your group and where you see things going? What things do we know probably will change, and what are things that you think might potentially change?
Well, that's a great question. As many people as you ask, you will get probably different answers. One, I think the future is very bright. I think we're getting close to a vaccine that's being approved. I think there will be some side effects, but I think they're going to be minimal in the sense that I think the vast majority of people will respond positively to the vaccine. I think not to sound like the economist in particular, but I think when we begin to get immunity through the benefit of this, hopefully this miracle vaccine or vaccines that are coming out, I think the economy is going to take off like a rocket ship. Yes, we will forever be changed, but the half life of that change, I don't know if it's going to be 6 months. I don't know if it's going to be a year. We are social creatures. We want to be back together. I look for restaurants, at least in the first few months, just to be burgeoning. Now, the other piece from a model development standpoint, Mark, I think regulators will relish. Unfortunately, the high side of this, or the best side of this, is that we now have data from another economic event, a major economic event. So not only the financial crisis, but now we have pandemic, and we understand better what impact it will have. That will certainly be manifest in the models. The trick, and it's just messiness from a data standpoint, is what accommodations or delays and defaults were due to accommodations, as in COVID, versus not, because not everyone's taken accommodation. They've really toughed it out. They've tried to stay true to banks. We don't think of ourselves as evil. We're not evil. We're trying to do the right thing. And so many of our clients are trying to do the right thing by themselves and by us as well. But I think the data handling will be very, very important in order to differentiate accommodations versus not. I think regulators will want what I might call the Monday morning review of, okay, how accurate were your models? Did you need overlays? Did you not? I think we're going to be more intelligent about what industries will be impacted.
Right.
The other one, which is a wild card that economists are very careful to point out, and that is government intervention. We've had some very novel government intervention, and I think we're getting another round soon from what it looks like we're headed. Of course, like it seems like a universal answer. How much is it? That universal answer is not enough. That's not a critique for me. It's just what I'm reading. When you have that novel help from the government, which is unpredictable, even though most people say we'll probably get it, but it's almost more of a likely, not a given. That also has almost what I might call an artificial impact on data. It's not natural. Doesn't mean it's not healthy. It's just not natural. And so, Mark, that's another thing that I think we'll be able to quantify. Usually, most of the time, models, quantitative area folks are pretty bright and innovative and determine ways to basically inference what would it have looked like without government intervention, what would it look like, what did it look like with government intervention. And ideally, they can establish a delta, a waterfall of sorts, to be able to quantify the benefit. And I'm sure that's already been done with the first two stimuli. And may have served as a pretty material motivation for a third one. So, anyway, long-winded answer to your question, Mark.
No, that's fantastic, Charles. I think that really brings this conversation home to kind of say, like, we're going to look at the future impacts of what this government intervention has been, and kind of reevaluate the data and assumptions, and just make sure that we know what we got right, we know what actually changed, and we can plan and have another tool in our pocket to deal with this next time.
Absolutely.
So,
absolutely.
Charles, excellent as always. Thank you so much for attending, and I hope to see you again soon.